Well, good morning, everyone. Thank you for showing up today for our 9:30 workshop. I am Brianna Ross, the Office and Events Coordinator for the Small Business Center here in Belleville. We cover the areas of Belleville, Quinte West, Hastings County, Prince Edward County, and Lennox and Addington. Just a reminder to everyone, please put yourself on mute. Thank you. So today we have Edward, and I didn't get to ask you this question before we got started, but Edward Swaya. Swaya.
Yes, you got it.
Okay. He is the founder and the managing partner of Swaya CPA, a tax and advisory boutique firm focused on providing a holistic advisory approach to its clients and mostly small and medium-sized business owners. If you have any questions about him, or I will also give you his contact information as well as his website if you wish to reach out to him at a later date. And today we have, so this workshop essentially is on the money side of business. So this is essentially an advanced session explaining the basic tools and techniques of financial management for essentially any business owner. And we're going to discuss the main keys of business financials, which is the budget creation and monitoring your cash management, product division and customer analysis, and planning and forecasting trends. So essentially anything to do with on your financial side, this is essentially going to help with your cash flow and manage your cash flow, and essentially understand a little bit more on your financial side of your business. Just a reminder, this is recorded. So if you have any questions and you do not want to be recorded, I will stop the recording at the very end. So, but if you do have any questions throughout the workshop, please direct them to the chat and we will address them throughout the workshop. I will now pass it over to Edward.
Good morning, everybody. Thank you, Brianna, for having me. Belleville area is close to my heart. I travel to Ottawa quite a bit, and our usual stop is in Belleville, and especially with the kids for Reed's Farms. They like the ice cream there. So I do have a couple of clients from the Belleville area, even though I'm based here in Toronto. So again, thank you so much for having me. My name is Edward Swaya. As Brianna said, I am the founder of Swaya CPA, which is an accounting tax advisory firm geared towards small businesses like the attendants today. If I could start by asking the audience, maybe 2 or 3 of you at least, if you could tell me just quickly what kind of business you're running. This is relevant to this session we're doing, and especially in terms of the examples that I'll be using during the session. So just a couple, 2 or 3, or even more if we can, just to have an understanding who's doing what during their business days. Any volunteers? Anyone?
Hi, it's Todd here. We own Redham Construction, small construction company here in Quinte West. We do framing, brick, block, stone, outdoor exteriors, and general contracting.
Okay, wonderful. Yeah. Anybody else?
We have a few in the chat here. We have PSW Home Care Service. Someone is starting a gourmet hot dog company, online magazine and virtual marketplace in Prince Edward County.
Well, that's excellent. We do have a variety of small business owners, which is great. This session here is obviously relevant to each one of you. It will affect you slightly differently in terms of budgeting and cost of doing business and so on. But the principles, the general principles apply to all. And for Todd, I would say that, I had exposure to construction when I was developing my own real estate in the past. So I understand your business very well. So without further ado, let's delve in. The common questions you folks would have is, tell me about financial management. How do I manage my business from a financial point of view? I know how to run my business, but sometimes I feel like I'm overwhelmed with the numbers. And what are the tools out there to help me manage those things, manage my business in a better way? The biggest question every business owner needs to ask themselves in an honest fashion is how to determine whether my product is being profitable without spinning our wheels too much and looking busy and being busy. And at the end of the day or at the end of the year, we don't have much to show for. And this is why it's important to have financial management tools in front of you that you could access and you use on a weekly basis, on a monthly basis. And we'll talk about those in a few minutes. What's my most profitable product? Again, depending on the product that you're selling, do you actually have to offer all the products that you can offer? The question is, should you offer them, even if you can offer them? If I could talk a little bit about my practice, for example, I focus on businesses as opposed to individual tax returns, because I find that I could provide the best value for my clients' money if I focus on businesses as opposed to individual tax returns, where people could, in downtown Toronto, you could file your personal tax return for literally $18. So that's not my profitable product, and this is where I don't sell my services. So you have to be honest with yourself and see whether the products that you're offering, are they the ones that you are feeling good about, and are you actually making money on them? Same thing with the customers. Some customers they end up being not so profitable, and it'll be hard to let them go. But for the sake of the survivability of the business, you have to decide whether you need to keep those customers or not. And the next question is, why do I need a budget? I suppose most of us would know why do we need a budget, but the idea is for a budget is, if you don't know, if you're not planning on where you're gonna go, you're gonna end up probably somewhere that you didn't want to go in the first place. Again, we'll talk a little bit about how to create a budget, what reports do I need in terms of financial statements, income statement, balance sheet, and so on. And how do I tell where my business is headed? So before I get going, I'd like to ask another question. Anybody has a bookkeeper right now doing the books for their business, whether that you started 2 months ago or whether you started six months ago? While we gather the answers to this particular question, I'd like to say that a bookkeeper should be always your first hire. Always, always, always your first hire. If you have started your own business yourself at home or in a garage or out of your truck, and chances are you don't know much about bookkeeping and how to keep the books. If you do, that's obviously wonderful. But if you do, you would have probably been a bookkeeper. So most business owners are not literate when it comes to keeping their books in a tidy fashion, in a more relevant fashion and timely fashion, which is extremely important. So I always recommend for business owners, however small their business is to the first hire that they should look at is a bookkeeper. And when I say hiring a bookkeeper, I don't mean that you need to hire a full-time bookkeeper. Depending on how small and medium-sized the business is, you could actually manage by hiring a bookkeeping firm or a bookkeeper on a part-time basis. It could be only 4 hours a week. It could be 4 hours a month. It depends on how much activity you have. So if you are in retail, for example, and you have hundreds of transactions a day because you're selling some kind of thing online or in a physical store, then the bookkeeping may become a little bit more intensive and needed on a weekly basis. If you are in the construction business, perhaps 4 to 6 hours a month is sufficient to track your, the collections from your customers, and then also whatever invoices that you're paying for your tools and equipment, and also material for the job you're doing. So
we have
go
a
ahead.
question in the chat. How do you know what accountant company is best for your small business?
Well, you want an accounting. Obviously, the accounting world is big, and accounting firms they come in different sizes. Now, the accounting world does make it somewhat simple for you. So, in other words, the big guys, they don't cater to the small business owner. Unless you become bigger and bigger, then they could come after your business. But so that basically weeds out essentially the big players, and the big players are actually not available in the Belleville area. So you'd want to go with a firm that is dedicated to small businesses, who has the experience themselves. They are a small business, and they know the pain and the joy of running a small business. So you would want someone who is significant enough to understand the issues when it comes to small businesses. When I say issues, accounting issues, taxation issues, planning issues, helping you with the financing, for example. And you would want somebody who is accessible to you. I always say, and it is on my website, if you are talking to your accountant once a year, it's time to change your accountant, because your accountant should be side by side with you at every major turn in your business. So these are the criteria you need to look at, is that are they available for me on an as needed basis? Do they understand small businesses? What are the profiles of their own clients? Are they catering to small businesses, or are they busy with having 5,000 personal tax returns like some small practitioners do? There's nothing wrong with that, as long as they are focused on individual tax returns. All the power to them. But come tax time, the individual who's doing 4,000 tax returns for individuals are not going to have time to dedicate to your issues when it comes to small businesses. So, like I said, you would want somebody who is knowledgeable, who is agile, who is available, who is accessible, and who understands small businesses, and give you value for your money. Now, when it comes to bookkeeping, almost anybody could do your bookkeeping. I shouldn't say almost, but that's kind of the first step. As I said, if you are not able to do your books, then a bookkeeper could do that. Now, small firms like myself, we provide kind of the full stop shop, basically, for our clients. We provide them with the monthly or quarterly bookkeeping. We do their financial statements. We look at we help them with their budgets. We do their corporate taxes. We do their personal taxes at the end of the year. So your bookkeeper does not have to be a standalone person. It could be, but it doesn't have to be. So I hope I answered this question about who is how do you find your best accountant out there? And then you interview them. You ask the tough questions. What do they think about your business? What do they have similar businesses like yours? all these questions are relevant and should give you some comfort on whether you should be hiring them or not. So,
They said,
sorry, Brianna?
I said, they said, thank you.
You're welcome. Okay. Okay, so this presentation is long, so I'm going to go through these slides as fast as possible. And please don't be overwhelmed. You could stop me anytime you want. You could ask questions. CPA Canada, who put these presentations together, sometimes they, unfortunately, they put a lot of stuff on it, in it, and I don't think this could be done in a 45-minute fashion. But I'll do as much as possible and try to answer the questions, because these are, in my opinion, a little bit more important than the presentation itself. So what is financial management? It's essentially, you do most of these things, you do them intuitively without actually thinking about them, without naming them as accountants would name them. So in other words, if you are in the construction business, if you are in the retail business, you know more or less whether you are being profitable, but it would help if you put it on a piece of paper and think about it and see where you are lacking in terms of profits, or you're making too much profit. Hopefully you're somewhere in the middle, that you're making enough profits to make your business sustainable and allow you to live a comfortable life, grow your business in a good fashion, and provide good service for your customers. So you need to track your performance. And how do you track your performance? You need to analyze your results on a monthly basis. This is why I go back to the issue of your first hire should be a bookkeeper or a bookkeeping firm, because if you don't track your numbers on a monthly basis, it is very hard for you to analyze these numbers. They say in any business, anything that is measured could be improved upon. And if you don't measure what you're working on, it's hard to know whether you're being profitable or not. This is why documenting your revenues or sales and your expenses on a timely basis, and let's say on a monthly basis, is extremely important. Because if you're gonna wait until a year down the road or 2 years down the road, when CRA starts calling you and sending you nasty letters saying file your tax return, by that time it's a bit too late. It's a bit too late to know whether you made some money or not. Now, I'll give a live example, which I see all the time in my small business clients, especially the ones who come to us sometimes late in the game. So we all know that we collect HST on our revenues. We also know if we have some employees, that we know that we have some source deductions that we have to take off their checks and submit that to the government. When you're too busy and you're scrambling, or you're not making enough money, chances are you're going to be spending that HST money that you collected from your clients and customers, and also the money that you should have put on the side and submitted to the government when it comes to source deductions. So I've seen people get into trouble by spending that money, by using that money for the business itself or their personal expenses. And then come the time when they need to file their HST returns, or they file their payroll records, then they don't have that money and they've spent it. And so that gives small business owners, or some small business owners, the illusion that they're making money, when those particular taxes, whether it's the HST or the source deductions, it's not your money, it's the government's money, and you need to submit that on time, all the time. Otherwise, there'll be severe penalties for not remitting those funds, and of course, the late filing penalties, and also interest accumulated on top of those things. This is why it's important to have, timely bookkeeping being done, so you could actually come up with an idea whether you're being profitable or not. And the idea is not to just stop there. The idea is, once you know where you're making money or where you're not making money, is to adjust your approach, whether you need to cut down on selling one particular product or increase your pricing, as long as you are still being competitive with with the competition.
So Edward, we do have a question, and I could probably answer this question with a simple answer, but I'll
Sure.
just let you know. Can you use QuickBooks in replace of an accountant, or do you have an accountant as well as QuickBooks? My answer to that is have an accountant as well. But I'll let you answer that, Edward.
Yeah, well, QuickBooks is and we use QuickBooks for our clients. So the clients sign up to QuickBooks or some other accounting software that somewhat are a bit cheaper than QuickBooks. But there's a difference between using your QuickBooks, which is a bookkeeping software, and even using a bookkeeper versus an accountant. A bookkeeper basically essentially records the transactions as they are given to them, as they are shown on your. Sorry, somebody said something?
No, they just didn't put themselves on mute. That's all.
Oh, I'm sorry. So a bookkeeper is a person who actually basically records, and this is why it's called bookkeeping. So keeping the books or recording the transactions that do happen on a weekly, daily, monthly basis. So if usually the bookkeepers, they look at the bank statement and they see, the sales coming in. So they record these as sales, and then they see, in the old days, checks being written or e-transfers being made, and they record, what these things are. Now, the accountant would have to take that monthly information and put it in a format, in a financial statement format, which we touch on now here is as an income statement or a balance sheet. Now, some bookkeepers are better than others that will actually, come up with the financial statements if they are experienced enough. If they are just starting out, well, they can't really bring everything together into a financial statement format. And even if you have a good bookkeeper who's doing the financial statements, at the end of the year, you still need an accountant to make some other adjustments to the financial statements, which the bookkeepers do not do, and also work on your taxes as well. And then give you some, overall advice on where you're going with your business. Are you being profitable? Are you bleeding money on certain products? Should you drop certain products? Should you market other profitable products that you're doing? A bookkeeper cannot do these things, and certainly the QuickBooks or any other accounting software does not do that for you. But you should certainly have an accounting software being used if you are comfortable with IT. These accounting software, they're not rocket science to figure out, although they could be tricky. As long as you are showing these books to an accountant on a regular basis without going too far into the future without someone looking at them, because you could be recording stuff the wrong way, and those things, if you keep going like that, then chances are we will have to fix 12 months worth of information as opposed to fixing 1 or 2 months. So definitely, I recommend you do have a bookkeeping software, and if you don't, then like I said, hire a bookkeeping entity that could do this for you. And it doesn't have to be, like I said, you don't have to. Most of you folks don't need to have a bookkeeper full-time unless you're generating $1 million in sales and more. Then you probably need to have a bookkeeper on staff that could double up as also an admin person. So we will talk about financial statements, budgets, forecasts, industry benchmarks. So here again, what is financial management? Again, these are slides that a bit soft, but I'll go through them quickly, and we'll discuss the main points, which are the income statement and the balance sheet and so on. Financial management, again, we touch on it, like product and customer analysis. You need to know whether you're if you're selling a bunch of products, then I heard someone who's starting, I think organic hot dog company, which is fantastic. You may end up having 2 or 3 or 10 different products, and at one point you need to see which products are more profitable than others, and are they all profitable? And if some of them are not profitable, should you keep the non-profitable one? Obviously, the simple answer is to drop them and move on and keep going with the more profitable ones. So we talked about timely reporting. Again, if you don't have bookkeeping going on a frequent basis, it'll be very hard for you to understand whether you're making money or not. And you don't want to wait a month or 2 or 7 or 12 until you figure out whether you actually made money on your business or not. So we will talk about trend analysis, basically to see whether you're trending in the right fashion. Is your business growing? Is it growing profitably? Or are you bleeding money? Are you borrowing more money? Are you from friends and family or from your bank to keep going? And you'd only know this when you look at your financials in a timely manner. So product analysis checklist. How do I determine if my product is profitable? Well, it's somewhat intuitive here. So you're gonna list all your products. If you have a couple of products, then it becomes easy. So, and then you say, okay, here are my gross sales from each of those products. And so that's the easy part, to identify the gross sales, because you know how much you sold. The harder part is to identify the cost of goods sold. Here we're talking about the actual material that goes into your product. So for Todd, for example, if he's doing framing for a house, he typically bid on a framing house, like, I don't know, it used to be $9 a square foot. It's probably now 12 or 13. It depends obviously on the market. So that's easy. If he's got 1,000 square foot place and it's at $12, his sales are essentially at $12,000. Now the harder process is to come up with the cost of goods sold. So typically Todd would not pay for the lumber, but he would pay for for the nails and so on. So that's kind of what the cost of goods sold are. And also he needs to figure out how much of his time is putting into this particular job and how much labor he needs to hire for this job. So if his time and a helper is going to cost him $6,000 plus $500 for the nails, then his cost of goods sold is $6,500. Now, notice here we're not talking about Todd's other operating expenses, his truck, his phone, his gas, his insurance, all that stuff. This will come later. Here we're focused on the cost of goods sold, which is go directly into the product, which is framing in our case here. So it is obviously any material that a framer would need to pay for, and any labor that he or she has to pay for. So now the cost of goods sold is $6,500. The sales are $12,000. Your gross profit is $5,500. Now, if you stop there, obviously you're being very profitable. So that's $5,500 over $12,000, and your gross margin is around 40%. So that's all wonderful, until you find out exactly what your operating expenses are, which we will touch on later on. But the first step you need to do to make sure that you are on the right track, that you're making money, is you need to figure out what is your gross profit or what is your gross margin. And the way to do that, as this slide is showing, is essentially your sales or your revenues minus your cost of goods sold. Okay, that gives you the gross profit. So I'm suspecting everyone on the call knows how to do these things, and you need to be honest with yourself and careful when you're putting these numbers together. You want to make sure that you are capturing everything that goes into your product. So if you are in the hot dogs business, well, you know, how much water you're spending, how much meat you're spending, you know, in terms of labor, how much labor is it costing you to come up with the, you know, a batch of hot dogs. So that basically gives you the gross profit. Now we go to product analysis. Again, this is intuitive. How do I determine how profitable my product is? You got to divide your gross profit by the gross sales for each product, basically. So if you sold 1,000 packs of hot dogs a month and you made you know, $2,000, then your each hot dog pack is making $2 for you. So that's an easy thing to figure out once you know your actual cost that goes into your products. So, and the gross margin, when you hear the gross margin or the ratio of gross margin, is essentially your percentage of profit, basically. So if you're making $2,000 on a $10,000 sales, well, then your gross margin is 20%. And that is important to distill down your profits to a ratio. Because you do want to compare yourself to the industry. This is how you know whether you're leaving money on the table and whether you're going to continue being a sustainable business into the future or not. So if the industry or the competition in your industry is making 25% gross margin, and you're making 20%, then perhaps there's a chance for you to, and there's a room for you to increase your prices without losing too many customers. Now, a question may be, well, where do I find these gross margins for my industry? Well, the internet is full of them. So you could, if you Google any of the industries that you're working in and find out, you know, say, you know, research for gross margin ratios, then chances are you'll be able to find something. So for example, if you are in the grocery business, which is tough to be in these days because only the big players are playing this game. Typically, the gross margins for grocery chains is actually very tiny. Now, how do they make money? They make money from volume, obviously, because they sell in the billions of dollars a year, and their margins is thin. Same thing with the restaurant business. It's also considered to have 3-4% gross margin, or net margin, I should say, which is after their operating expenses. So it is important for you to calculate these things on a if you don't calculate on a monthly basis, at least on an annual basis, and compare it to prior years. Is it improving? Is it declining? For example, I could bet you restaurants, even though they've jacked up their prices, but their margins came down the last 24 months, mainly because their labor costs went up and their food costs went up. And they couldn't, even though they increased their prices, they could not pass every increase in their cost base to their customers. So their margins is suffering a little bit, which is a risky proposition for them, because lower margins will lead to business failures ultimately. So here we talked about customer analysis. Once you know how profitable each product is, what can you do? You have to compare your product pricing to the market. We touch on that by making sure that you are competitive without leaving too much money on the table. Because at the end of the day, yes, we all love doing what we do, but you won't be doing this for long if you're not being profitable. And that's the idea with this session, is to make sure that you are tracking your numbers on a timely basis, on a more frequent basis. So you may have to adjust your pricing to enhance your profitability. How do you know this? Again, by looking at your numbers on a monthly basis, on a timely basis, to see whether you need to increase your prices or decrease your prices, depending on on your product and depending on the competition. So if you're being, if you're selling your product lower than the competition, perhaps there's room for you to increase your price and command better margins on your business. Talks here about focusing marketing and delivery methods. Sure, you know, if you see that some of your products are being extremely successful, maybe this is where you need to spend even more marketing dollars and to sell more of your profitable product. And then again, we touch on consider dropping unprofitable products. However difficult that decision can be, because some of your customers got used to that product. Remember, the sustainability of your business is the most important thing. And for you to continue on selling unprofitable products, well, that's not sustainable for the long term. They talk about here about the loss leader, which we all know what that is. Essentially, when you go to a supermarket and you see a product that is, you know, even before you go to the supermarket, in the old days, those flyers come home, and you know it's $1.99 for something typically sells for $4. Well, the supermarket is actually losing money on this, but this is what they call loss leader to bring you in. Now, small businesses typically they cannot survive on too many of these loss leaders, and I don't know too many small businesses who actually offer them. And I'm not suggesting that you need to offer them, but we're talking about some examples here. So again, customer analysis is extremely important. Product analysis is extremely important to see whether your products and your customers are sustainable to keep servicing them or not. And this is where the tough decisions by you would have to be made. Here it talks about specifically about customers. Again, list all your customers or customer types, identify typical shopping cart per customer. Again, identify your gross profits, which now you know how to come up with, which is sales minus your cost of goods sold, and then come up with the gross margin for each customer. So in my case, if I could again go back to my own example, I figured out that, you know, my best time is being spent on catering to small businesses as opposed to an individual person with a T4 at the end of the year. So somebody in the construction business may focus on commercial clients as opposed to residential clients. You know your business the best, and you need to figure out where you need to spend your energy and your time and effort, and to see whether it makes sense to keep certain customers and certain products. Again, this is a tip about how to, you know, you need to sort out your customers by gross profits and gross margins. Again, it talks about, you know, we touched on this, whether you need to keep some of those customers or not. The key financial management reports, I'm sure most of you have heard about the financial statements, which are composed of 3 subsections, if you will. One is the profit and loss statement, or they call it P&L, or income statement. That's another name for it, which essentially lists all your revenues, which are your sales, and then it talks about your cost of goods sold, and then it also lists your operating expenses, whether your vehicle expense, telecom, insurance, your professional fees, you know, interest on your loans if you have a loan, you know, cash charge, you know, bank charges, and so on. The balance sheet is essentially, it talks about, you know, what you own and what you owe. So, you know, what's your cash in the bank? If you have any accounts receivable from your clients, if you have any assets like trucks, vehicles, equipment for your business, those are on your balance sheet. And on the other side of your balance sheet are your liabilities. Essentially, if you have a bank loan, if you have a mortgage payable to your lender, those are on your balance sheet. And those are, you know, you could produce them on a monthly basis from the bookkeeping that you are doing on a monthly basis. And then the cash flow statement talks about, the cash in and the cash out. Profitability ratios here we talk about, again, remember we talked about gross margin ratios. For example, if your margin is 20%, but the industry is 18%, so clearly you're doing well. You're commanding a little bit of a premium compared to the competition, compared to the industry, and that's probably because your product is superior. Maybe you're providing better service, and so on. And then the last thing is budgeting and forecasting, which we will touch on. So let's actually start with the measuring profitability, which we touched on already. So again, you take your monthly gross sales or your annual gross sales or your weekly gross sales, whatever the frequency you would like to choose. Typically, if you are able to do it on a monthly basis, that is actually a wonderful start for a small business. And again, don't let it go for too long without you sitting down on a quiet day and assessing your performance, your financial performance. So as the example says here, your monthly gross sales 20,000, cost of goods sold is 9,000, gross profit is 11. Obviously, the gross margin is 55%, which is 11 over 20. Absolutely, clear is that the higher this ratio is, the better it is for you. Okay, and it's not good enough to stop there and say my gross margin is 55%, which on the surface it looks wonderful. Okay, but how does this compare? First of all, how does it compare to the industry, to your competitors? And how does it compare over time? So if in 2022, your gross margin was 55%, but in 2021, it was, for whatever reason, it was 60%. There's something happened. Either you did not increase your prices to adjust for inflation, or you started paying a little bit more on your cost of goods sold, because now your margins is down, and that margin is important to keep at a steady pace or improve if you can, without shooting yourself in the foot by alienating some customers. Because to increase it, it's either you're going to have to be doing something better, faster, which will decrease your cost of goods sold. Meaning, if you're doing something that was taking you 5 hours, now it's taking you 4.5 hours. Well, that's going to improve your margin. And then what could also improve your margin if you increase your prices without, turning off some customers from you. So this gross margin percentage is kind of your first test of your profitability. Am I making enough money before I have to pay for my operating expenses, which we will touch on in a couple of more slides. As I said, it is important to measure this gross margin ratio or percentage and compare it to at least two things. Compare it through times and compare it to your competitors. All right, now here again, we continue with the same example. Here we're just deducting operating expenses, and which is another $5,000. Now your operating profit is 6,000. Again, your operating margin is 30%, which is 6 over 20. Again, the higher these percentages are, the better you are to continue on with your business. So, and you have to manage all these components. You have to manage your sales. Am I being competitive enough? Am I charging enough for my services? Am I leaving too much money on the table? The ways to know all the answers to these questions is by doing something like this analysis, which on the surface, I understand it looks basic, but you need to obviously capture all these expenses and all these revenues. Brianna, I know we're doing very bad on time, and this is what I said from the beginning. This presentation is way too long for 1 hour, and I know we're like 12 minutes from 10:30. So, what do you recommend? Are there questions out there?
I was gonna say, I'll put it on the people. So if you want us to keep going, We keep going, of course. We'll go right till 10:30. And then I guess at 10:30 we'll do questions, and then we'll open up the floor and then I guess go from there. So it comes down to everyone who's attending. Keep going, please, so far.
All right.
Absolutely.
All right. The next slide is, again, it builds on the one before it. It's essentially sales minus the cost of goods sold, minus your operating expenses, minus any taxes and interest. Again, this is your net profit. Again, the higher these ratios are, the better for you. It's like football. The higher the score, the better for you, essentially. So the main point about all these things, you've got to, and I know it's not enjoyable, but especially when these numbers are not looking good for you. But this is the point about these exercises, is that you have to do them. You have to do them on a frequent basis. You cannot afford waiting 12 months after the fact, or 6 months after the fact, or 2 years, like I said earlier, when CRA starts, sending you letters, file your taxes, because it will be too late to see whether you actually made money or not. So those are things that are important. You have to take the time out of your busy schedule and do them on a weekly basis if you can, and if not, at least on a monthly basis, to see where you're going with your business. Because at the end of the day, like I said, however love you have in your business, if you're not sustainably profitable, you cannot continue. You'd have to shut down and move on to something else. So extremely important you do this on a timely basis. Other ratios that you could use is return on assets, return on equity. So these are for the accountants in us, they are simple, but it may not be intuitive for you guys. But if you are, let's say somebody has a business that is they invested $50,000 of their money, and they bought assets, equipment, furniture, whatever the case is, and they spent $50,000 of their own money. And then at the end of the year, they're generating $10,000 of profit. Well, the return on your assets is 10/50, which is 20%. Again, those ratios, they're not meaningful by themselves. You have to compare them over time periods, and you have to compare them to industry. So if your return on assets, and if you're just starting now doing these things, and you're going to start because this presentation triggered you, that's wonderful, but there's not much you could compare it to, except if you're comparing it to the industry. So, but in a year from now, you'll be able to compare 2023 to 2022, for example. And then you continue on with this, and that's a better way of managing your business. Return on equity is the same thing, is how much you invested without actually borrowing, and how much you made. So for example, the banking industry in Canada, they generate around 11 to 15% on return on their equity. So for example, TD, which is a better run bank, generates around 15% return on their equity. The smaller banks like BMO and CIBC generate 11-12%. And these are the benchmarks in the industry. And like I said, you have to compare yourself to your competitors. You also have to compare yourself to what you did last year and the years before. So we get to a topic that is extremely important, is a budget. The question is, why do I need a budget? Well, the answers are obvious. As the presentation says, if you don't know where you plan to go, you could arrive anywhere. And this is not where we want to be for our business. You want to come up with a budget, however painful it is to come up with a budget. And this is where your accountant should be helpful in leading you and even helping you to achieve that budget and try to stick to it. So it is important for you to say, this is my expectations of how much money how much sales I'm gonna have this year. What are my expenses? And then this is my profit. And then the reasons for coming up with a budget are multiple. One of them is to keep you disciplined through the year. and see whether you're going to be able to meet that budget. But also, the budget is a tool for you to plan ahead. So in other words, if you're going to tell me, Ed, I want to double my business, and here's my budget, and all of a sudden your sales of $300,000 a year, you put it at 600,000, but then you don't match it with your expansion, with an increase in expense, and obviously the budget is deficient. So the budget is a planning tool to say, okay, if I'm planning on increasing my doubling my business, well, what do I need in the next 12 months to come up to be successful in my budgeting to double my business? So do I need more equipment? Do I need to hire more people? Do I need to go to a banking institution and borrow a little bit of money to buy that piece of equipment, which will allow me to increase my business? All these are decisions that will be trickling down from your budget exercise. So this is why it's really important. It's not only a financial exercise to say, you know what, yeah, I think I could do this, but the questions are, how are you gonna get there in the first place? By hiring more people, by leveraging technology, by getting more equipment, by buying an extra truck, and so on. So here's a simple example of a budget where you said, my budget is going to be $40,000 in terms of sales, and my cost of goods sold is 20,000, operating expenses 12, my net profit is 5,200. And then here you ended up selling more, but obviously you selling more, that entailed you buying more of the stuff that you need to sell, and then you kept your operating expenses at a steady pace, which is a good thing, because this shows that you were able to grow your business without incurring additional costs. Now, obviously, you could do that up to an extent. Then eventually you'll have to start up, increasing your operating expenses somehow, either, getting a bigger space, hiring more people, borrowing money to buy a piece of equipment, whatever the case is. And again, the idea here is to ensure that you come up with a budget that is reasonable to achieve, and then you stick to it during the year, and then you analyze it as you go. So here's my budget for the first 6 months of the year, or 3 months, or per month, and how am I doing against that budget? Am I tracking it in a positive way? If so, why? Like, maybe because I had launched a good marketing campaign that increased my sales. If I'm not tracking it positively, well, again, these are the tougher questions. Why am I not? Is my product not being accepted positively in the marketplace? Am I not doing enough marketing? So again, the whole idea about your financial management is to analyze where you are, but also to lead you to where you want to go, essentially by making some adjustments along the way, either decreasing your expenses because your operating expenses are out of whack when they are compared to your sales, when they are compared to last year's results, when also they are compared to your industry. All these things, you have to analyze them on a regular basis. And again, if you don't have the books in place that are done on a timely basis, it will be very hard for you to read these things. This is why we go back to your first hire should be your bookkeeper, as I said earlier. Now, this is again, this is a budget from a balance sheet perspective, which is basically your cash is a little bit higher because you sold more. Which is basically coming from this slide here. You were able to generate more profits, and that translated to a higher cash balance, essentially. So that's the budget. How do you develop a budget? Well, you're gonna have to use your, obviously there's a lot of judgment that goes into putting a budget together, but you're not typically starting from scratch, unless you're really starting your business from scratch. But if you are in the business for the last couple of years, then you want to obviously look at your historical financial performance and use that as the starting point. And if your aim in 2023 to grow your business, then you're going to say, you know, if I generated $300,000 in sales last year and I want to increase my business by 20%, because I know I'm going to work harder this year and I could increase a little bit of my pricing because of inflation, and I'm going to actually launch a big marketing campaign, then, you know, 20% may be achievable. You know your business best. So 20%, then your budget becomes $360,000 for 2023. And based on that, you have to come up with obviously the expenses attached to these things, which again, you should use your last year's numbers as a roadmap, if you will. So again, there's a lot of information out there on the industry. Your accountant should be able to help you with come up with a reasonable, achievable budget that you should stick to and analyze as you go through your business. Next is budget analysis. We touched on that already by saying when you come up with a budget, you have to, you know, compare it to your actual results. This is what they call about variance reports. So if your budget for the year was $360,000 and you ended up at $380,000, well, that's great. But what went well for you? This is where you need to investigate and understand all these variances. What did I do well? Was my Google ads, were my Google ads effective? Did I spend the right money with Google, or did I spend enough money with Google, or should I spend more money with them, or stop my marketing campaigns with them? You know, here it talks about unexpected trends. Trend is basically if you're going up or down on certain things. If you are increasing your sales and continuing to increase your sales, well, that's wonderful. Again, try to analyze it and why is it happening? Budget variances may indicate, you know, like we said, sales and marketing successes. It could be changes in the competition. It could be some competitor in the Belleville area that went out of business and a bunch of their customers came to you. Well, that's too bad for them and sad, but it could be good for you. But also use that as a inflection point, as also a study point is why did they go out of business? If there's anything that is, you know, blatantly available for you, were they pricing their product way too low? And that should be a warning sign for you as well to be careful with your own pricing. So I think I should stop here because it's already 10:31. So, Brianna, are there any questions that I need to take?
We have no questions.
Okay. If you're okay, I'm going to continue going until you tell me to stop. So, is that okay?
Yep, that's fine with me.
Okay.
If anyone has to step out, I totally understand. I know one person had to step away. But again, this is recorded too. So if you do have to step away, we understand. But
Yes.
I think we got maybe about 15 minutes left by the looks of the slides here. And I'd say,
Yeah, I think it's like another 10 minutes. So I'll be quick. So.
If everyone's okay with waiting about another 10 minutes and listening to the rest of what Edward has to say, we'll keep going if that's okay with everyone else.
All right. Okay, so here when you're analyzing your budget, and again, it's not good enough for you to come up with a budget. The idea is not to come up with all these reports and not using them intelligently. The idea is to make sure to leverage these reports to become better in what you do. So there are examples on this slide where it talks about, you know, weather, economic, market changes. So if you are in the construction business and the weather was so bad this spring, well, your business may have come down. And that's an easy explanation for a variance in your budget. You know, you expected the second quarter of the year to bring in, you know, $30,000, but it brought you only 18. Well, if the weather was not cooperating, then that's obviously is a good explanation. But also maybe the third quarter will be stronger than that was budgeted for, because you're going to have to make up the time to do the work that was already budgeted for. Okay, so cash analysis is extremely important, and I cannot overemphasize this particular point. You may be profitable or you are profitable, but if you are not managing your cash inflows the proper way and the cash outflows the proper way, you end up actually closing down, even though you may be profitable in your business. So what do I mean by that? If you are, it's extremely important to manage your receivables and your payables. If you are paying your suppliers in 30 days or less, but you are getting paid by your customers in 60 days or more, well, there's a discrepancy here between your cash inflows and your cash outflows. And that's going to cost you a cash flow problem. So even though you may be making money on your product or your service, but if you're not collecting your receivables fast enough, and if you're paying your payables too fast, then you're going to have a cash crunch. And that's going to, and there's no way for you to continue. You won't be able to pay your payroll on a bi-weekly basis. You won't be able to pay your suppliers on a timely basis. So it is extremely important for you to manage your receivables and manage your payables in a timely fashion. I always say that to my clients, and I actually practice it in my own business. When it comes to accounts receivable, the faster you bill your clients, the faster you collect. And there's many reasons for this. And if you remember anything from this particular presentation today, bill your customers as fast as you can and as soon as your job is finished. I know Brianna is smiling at this. I hope you agree. It is extremely important you do this for the reasons that we just discussed. So as I said, if you don't remember anything from my presentation, remember this: bill your clients as fast as possible. And like I said, there is a main reason for this, is that your customers remember the value of what you provided them only for a certain amount of time. So if you bill them as soon as you finish your job, the value of the service that you provided to them is still fresh in their mind, okay? And typically, they will pay you right away, okay? If you wait a week, a month, 6 months to provide them, your bill, then that value that was created in their mind is now years behind them, and you may have a trouble collecting from them. So now, obviously, you want to collect as fast as possible because of the cash flow issue that we talked about. So you want to make sure you bill as fast as possible. As the slide says here, high accounts receivable will use up your cash, and that could bring down your business, regardless whether you are profitable or not. So you have to make sure you keep on top of your billings and collections. And try to, on the flip side, try to postpone as much as possible your payables, while at the same time trying to take advantage of some discounts if you are able to pay on time or even before time. There are some suppliers out there that will tell you, 2% discount if you pay within 10 days, as opposed to making me wait 30 days. So I encourage you to take advantage of these things if you can, when they are available. So a trend analysis, it's important. We touched on it before. Essentially, trend analysis is to see how is your business trending. Are you trending higher or are you trending lower? Obviously, in every aspect of your business, trending higher is better. Not necessarily when it comes to accounts receivable, which we touched on now, but if your sales are trending higher, then obviously that's a good sign. And typically your accounts receivable will also trend higher if your sales are increasing on a monthly or annual basis. So you want to make sure to look at the trend. Are you increasing your sales month by month? Are you increasing your sales year compared to prior years? How are you trending in terms of your expenses? Is your payroll getting out of whack completely? all these things, it's easy to compare them month to month and year to year when you have the data available for you. So it's extremely important you do that. And that's another part of your financial management. Next is forecasting, which is essentially budgeting, but it's for longer than 1 year. So this becomes also harder, and it's also important. Now, the forecasting, I would say 100% of the time, you will never reach it bang on, and you will never be exactly as you forecasted your results. But it is also important to do it. And these are projections that are based on 2 years or more. Every business, every sophisticated business, even a small business, should have at least 2 to 5 year projections, and those should be reasonably put together, trying to achieve them. And again, these are important for you to come up with, because they will also inform you on what you need to do for your business, whether you need to hire more people, whether you need to beef up your equipment, and if so, how are you going to do this? Basically by being more profitable and using some of the cash flows from your own business to buy more equipment, or do I need to go to the bank and borrow money and to be able to grow my business that way? Again, the projections show where the business is heading. You're gonna need to use the trend and variance analysis, which we talked about. Variance, again, is the differences between actual and the budget, and the trend analysis is how are you comparing, or how are you growing your business? Is your trend going up? Is it going down? And obviously investigate and understand these trends. You have to make sure why, if I'm growing, well, what am I doing right? Is the competition losing their customers? Is competition out of business? Are there more people in my neighborhood, or in my coverage area? You need to investigate why this trend is happening, because it's either to see whether you could command a better price or keep the same pricing and try to grow your business this way. So all these numbers, all these trends that you see in front of you, you have to understand them, you have to investigate them to ensure that you keep growing the right way, basically. Again, we touch on trend analysis. Again, this is budget versus actual. So there's a variance analysis between these two categories, whether the budget or the actual, and then you're going to see how are you trending? Are you going up or are you going down? Again, we touch on accounts receivable. I cannot overemphasize this point, because this is basically the crux of keeping you in business. Make sure you manage your accounts receivable the proper way. So actually the presentation comes to an end this way. So any questions?